I remember last time we spoke to you about VC, you said 80% of MMA is happening between 150 and 200 million
Mhm.
price point, and it's mostly on the coast, New York and California. So it's crazy because like I want you just to kind of explain that because I think we just got to think, even if we're not at that level yet, we got to think broader range.
Yeah.
And just a lot of times we think like $50,000 or $10,000 is real money, $100,000 or even $1 million. Like the average deal is between 150 and 200 million. So talk about that a little bit.
Yeah, I mean, for sure, because I think I think the reason that statistic is true is because it skews towards the average skews larger because the larger transactions move. They're so much larger than the small ones. But also, shit that's worth buying is usually big, right? And so if you're talking about selling a business, like if the business is too nascent, like I couldn't sell Loop right now. No one would want to buy it from me. It's got a little bit of buzz, but all I got is like a Google Drive full of notes. You know what I'm saying? Like usually by the time you get to the point where you're transacting and you're unloading or acquiring a business, or in the master investors case, teaching you all about which stocks to buy, it's a mature company with robust processes and so on. And so I really am a fan of building, intrinsic value and locking in and building for 7, 8, 9, 10 years. I really feel like if you start a company, if you're fortunate, it is going to be a 10-year ride at a minimum. So if you can't see yourself doing something for minimum of 10 years, I wouldn't start it personally. And by the way, I know that there's going to be some people that listen and say, well, I just came across this ClickFunnels thing. I'm thinking I could do a little quick hack. That's fine, man. But like, yo, your time is precious, my G. And like for you to invest in something because you feel like you can, that's not how I measure my time. Like I want to do shit that lights me up. I'm ready to rock. I'm going to put my all into it. And people can tell when you do that. And that to me is a winning formula, a lot more so than doing something quick for the cash. So anyway, when entrepreneurs do lock in around that with that kind of attitude on a venture for 10 years, that's when the entities grow in value. And when you have repeatable processes that can run without you, that's when the valuations start to get very interesting. And once you grow to a certain tier, your business is valued based on a multiple of your revenue, right? So in the insurance industry, for example, your business is valued at 13x your revenue. So let's dissect this for a moment, right? If you grow a business to, if I grow Loop to be $10 million of revenue, which I do anticipate I should do within a couple of years, then a 13x multiple, that's $130 million valuation. Now, would I take that if someone said, yo, come and buy this? We're going to buy this for 130. This sounds like a lot of money. It is a lot of money, but my VCs didn't sign up for a 130. And also consider the fact that I sold a good chunk of the business, right, to my seed investors. So I sold a chunk to them. I gave a chunk to my employees. And so now I got to think, damn, by the time I build it to 10 million of revenue and is worth 130, if I cash out here, that's cool. But like you're usually growing at a decent rate. So you say, you know what, let me rock out for a little bit longer and see if I get this bad boy to 50 million. Once you're at 50 million in revenue, if you multiply that by 13x, so you guys start to see, so you start to see why the windows, why they get to what they get to. But quickly, let me just break down some multiple valuations for some other industries. If you're in media, as you guys are, is usually 3x your revenue. So whatever your revenue is, you multiply it by 3x. If you don't like what that brings you to, EYL, as a lot of founders don't when we're early, we say, nah, I'm gonna build this up until I can get the number that I want to have, right? And so if you're out, 500K in revenue, 3x that is 1.5 million. Would you sell it for one? Would you sell Earn Your Leisure for 1.5? Again,
Nah,
a lot of money, but nah. A lot of value to unlock. Now, if you grew EYL to 5 million in revenue and then they offer you 15 mil, okay, more reasonable, but I still think there's a lot more than that, right? And so that's the founder's dilemma, right? If you're in cosmetics, it's also a 3x. If you're in AI, get this, by the way, if you're in AI or data or some shit like that, 25x.
What about education?
6. So you 6x, 6 to 8x.
Get a list of this because I think this is really important for entrepreneurs because I feel like a lot of entrepreneurs jump into a business and don't know what the outcome could be. Please tell them where they can research.
Yo, that's a good question. Let me search around. I know this shit cold just from like.
This from some things you can't. You know what I'm saying?
Hey, we brought the plug.
You got it. Either you got it or you got it. Man. Like this apple from the apple orchard. So John, man, that EYL valuation in 5 years is a serious thing.
That's so. But to your question, Rashad, like that's why the average M&A, mergers and acquisition activity, gets to that range, because it's not like that you got 100 million in revenue. It's that you got revenue of X amount, and then based on the industry, and you're getting the multiple. Now get this for a moment, if I could just riff for a second. So whenever you're in technology, remember I said AI is a 25x. I'm in insurance, that's a 13x, but I'm an AI driven insurance company. So now you can get a blended multiple. I might not be able to get a 25x, but I'm a motherfucking salesman. So when it's time to sell Loop, and if we're at let's say 50 million in revenue, and they're trying to give me a 13x, I'm gonna say, yo, but we got a lot of data, we got this, we got that. I'm holding out for, it's like Hope says, he's like, they talking 250. I'm holding out. I'm holding out for 275. I just might agree. So it's all subjective. I want people to understand that valuation is really all subjective. Is based on what you could reasonably defend, and is based on market comps. So, you know what I'm saying? Like, I think Earn Your Leisure can command a multiple, because I don't think that you guys should be a pure 3x, because you have a lot of intangibles and a lot of brand that you can stretch and make it a 5x, for example. So valuation is subjective, man. I thought it was a really great question. I hope that people understand this is the underpinnings of venture, for example, which then grows up into public markets. In venture, when I was raising my round, I came up with a valuation. I came up with an aggressive one. And they said, well, why? And I said, because I'm a G, and because my co-founder is strong, and because we have this, we have that. And so it all depends on what you could sell. If you could sell it, great. If you can't, you got to adjust.
John, how old are you, John?
28. I turned 28 in January.
28 years. Happy birthday. So
thank you.
When I first met John, the first time I was like, what books do you recommend? He was like, I don't even fuck with books. I'll be honest with you. He was like, I know, like, but I say some people just got God-given ability to just, like, you know what I'm saying? Like, sometimes in life you're just a brilliant person. Like, you know what I'm saying? And it's like,
wow, I appreciate that, fellas. Damn.
What you asked me, like, where to get this from? He's the source. Like, you know what I'm saying?
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.